Well, you are in for a treat today with my guest, Ian Formigle, who is Chief Investment Officer at CrowdStreet, the largest, most influential real estate crowdfunding platform in the industry. You could almost say they define the industry. Adam Gower here. And if you've not read it yet, get your copy of Unleashed at the gowercrowd.com website. Just scan down the first page or the homepage and you'll find a link there to buy the book. In it, I quantify the real estate online syndication industry, aka crowdfunding, and identify CrowdStreet as being the largest player by around 10x its nearest competitor. CrowdStreet has raised over $4 billion in equity since inception, which is, as you know, an extraordinary number and speaks not only to how the online world is changing capital formation in commercial real estate, but also speaks to the sheer scale and influence that CrowdStreet has over the industry. In his position as Chief Investment Officer, Ian probably sees more deals and sponsors than anyone else in the industry. What you're going to be learning today will give you a detailed picture of where we are in the real estate cycle today, what the challenges and opportunities are, and how to turn what are difficult times to your advantage. Find out more about Ian and CrowdStreet, go to the podcast page at gowercrowd.com, sign up for our weekly newsletter, it's free, and pick up your copy of Unleashed, all there on the homepage at gowercrowd.com to learn more about how online syndication, aka crowdfunding, has come to dominate capital formation in the commercial real estate industry and how CrowdStreet has dominated everyone else. All right, let's move on. Ian Formigle, Chief Investment Officer at CrowdStreet, and tune in now to a discussion about the state of the industry with someone who has deeper insights probably than anybody else. Ian, goodness me, it's been a while. I've been trying to get this podcast recorded. Thanks so much for your patience. Yeah. Fabulous to see you. We are at a very, very interesting time in the economy. Actually, since the beginning of crowdfunding, this is the first time we're seeing the potential for a downturn in the industry, the fortunes of the industry. So let me ask, let's kick off with this question. Rising interest rates. And today, just to, of course, timestamp this, we've got another 75 basis point increase from the Fed. With interest rates rising, what is the impact that you're seeing on commercial real estate from both? Let's start with the investors. Let's start with investors first, and then we'll talk about sponsors.
Okay. So from investors' perspective, okay. So yeah, Adam, very interesting, obviously year, crazy how fast it has changed. Definitely a lesson learned in when the Fed wants to change policy and, put ice into a market, it can ice a market. We're now seeing it. So from an investor perspective, what we're seeing is all transactions. I mean, again, similar to the single family market, the commercial market last year had outrageous gains last year. Multifamily up 30%, industrial up 40%, storage up 60%. These are rough numbers, and in Green Street is a group that tracks these year-over-year numbers. And so just astronomical appreciation. So again, backing up, what happened in 21? Well, okay, yeah, free money. Yeah. So combined with a lot of injected liquidity, right? But there's that statistic that give or take 20 to 22% of every dollar that's ever existed was created since the pandemic, right? So massive inflection of cash into the system. So what happens when you make debt free and you jam a bunch of cash into
exactly that's
people go on buying sprees of everything, hard assets included. So hence we saw runaway appreciation. Now rents grew. We saw rents grow precipitously this last year. But what was crazy was that pricing even outpaced the rate of rent growth, even in this crazy rent growth last year, where multifamily was up solidly double digits, 20+% in some markets. And what that translated into was cap rate compression, most notably in industrial. So cap rate compression, absolutely in multifamily, it was already getting low, massive cap rate compression in industrial. So we entered 2022 where industrial and multifamily cap rates nationwide are sub 4%, right? So a sub 4% unlevered yield on the value of those assets. Never before have we seen those yields so low. So hence, the minute you start raising interest rates, and when interest rates are that low, which drove those pricing that high, because you could, coming into this year, rates were so low that you could actually support a 3.5% cap rate with some perceived growth. And now we're getting kind of the growth perspective, right? Because then the double whammy hits. You raise interest rates, you materially increase the cost of owning real estate. At the same time that those outrageous rates of rent growth come back down to earth. Because the reason that someone was willing to pay a super low cap rate last year was essentially you were buying the right to step into future growth. And you wanted that growth, or I should say the market wanted that growth. We looked at a lot of what was going on last year as like, this is unsustainable for sure. But the market wanted that rate of growth so bad that they were willing to pay record amounts for each of those types of assets. Now we fast forward to today, rates going up a lot. Now, when you take the Fed funds rate from essentially 0 to now, I think we're like above 4% with the latest hike. Okay, massive change, and cap rates are so low that the only thing that can happen now is that pricing can fall to begin to justify and reconcile with the cost of owning real estate.
All right, so this is an interesting question. Let me ask about this. I'm actually about to press the button after we finish today on my this week's newsletter. I send out a newsletter every week. And the big question is, I was actually talking to Paul Fiorillo as well at Yardi, who I had a bit of a debate with him by email over the last few days. The extent to which cap rates and therefore pricing is connected to interest rates. What's your view of that? As interest rates go up, do cap rates inevitably follow?
Yeah. Okay. So they correlate over time, but they can ebb and flow depending upon the influx of cash to the system and in supply and demand. So, for example, I would say that at the end of the day, supply and demand, on average, in normal environments, will still probably have a greater effect, I think, on cap rates than interest rates. Because if all things being equal, you stick more money into the system and you say, now you've got more money to chase the same number of assets. Well, they tend to do that, which will drive up the price, but the net operating income of the underlying fundamentals of the property didn't necessarily change. So what happens is that cap rates go down. Now, cap rate didn't go down because interest rate changed. It went because supply and demand really does change cap rates. And you can see this in data. For example, you can go back to the 2016, I think, to 2018 period. You can see that how in that period, Fed funds rate did increase over that period, yet cap rates actually came down. Right. But it's important to note that it's within margins of reasonableness. Right? There's still cash flow. There's still a reason to get into that deal. It's maybe not quite as juicy as it was, but it still made sense because there was growth. Now, what I will say is that when cap rates, in my opinion, more forcefully correlate with interest rates, it's when you smack right into the positive versus negative leverage dilemma.
Yes, exactly. Right.
Because if you think about this, right? If we buy a property and it has a 5 cap rate, meaning that without leverage, we have a 5% yield, right? The traditional mindset is if I can borrow at below 5% interest rates, I'm creating additional yield, and we want additional yield. Like this is a 101 of commercial real estate.
That's exactly right.
Borrow cheaper than the cap rate equals my leveraged yield is above the cap rate equals I make money over time.
An even better return.
Right.
Yeah.
So now you juxtapose that into, we got so far into such low cap rates for certain asset classes, right? We didn't go there as much for retail. We didn't go over there for hospitality. Hospitality, you kind of have to kind of throw out because
a whole different market.
It's a so different market because of the
Yeah.
pandemic, right? It's very, very singular what's going on in the hospitality market. But if you take the asset classes of industrial and multifamily, which were the ones where capital wanted to drive into those, then we pushed them cap rates all the way down to a level that when interest rates spiked, what we're now seeing, similar to the single family market, not even as much, but when an agency debt goes from 3% to 5.5% or 6% or 6.5%, that is a drastic difference in that day-to-day cash flow. And we do want multifamily, particularly stabilized multifamily, to cash flow. And all of a sudden, when you buy a property and say, my property is stabilized, so really what I'm banking on is some future rent growth. I want to maintain my occupancy. And what I want is I want a today yield. That's part of why I buy that property. And when cap rates get so low that the current agency debt equals that I have no cash flow, then you pause and you ask, why would I buy this asset with no cash flow when up until this point in time, for the entirety of people's careers, there has been cash flow in that asset. Today, there's no cash flow. Maybe, just maybe I should pause and not buy that asset, not fix my rate at zero cash flow, and possibly wait for, hence pricing to adjust equals cap rate expansion to justify getting it back into that asset when cash flow will return. That is the today market.
It is, isn't it? It's really interesting. And now what happened last year was this explosive rent growth. And if rent growth accelerates faster than the impact of rising interest rates, then you still do have growth, right? You've still got increasing NOI. And so cap rates can stabilize or go up a little bit less, or maybe, they're not so badly affected. But one of the first things that you said was a deceleration of rent growth. So what are you guys seeing in the market as far as rent growth?
We are seeing, yes. So what we are seeing in terms of, let's talk about multifamily. Multifamily rental rates on an annual year-over-year basis are still increasing. But the rates of increase are no longer looking like double digit, no longer 11 or 12%, and no longer 20% in the hottest markets, right? The markets that looked like Orlando last year and parts of Miami. Now they look solidly single digit, 5-6%, which is still above trend, right? Over time, if you look across the arc of history, the increase in rental rates can gravitate somewhere from 2 to 4% on average in years, right? It'll migrate up and down, which is why a fundamental underwriting practice in normal times is to underwrite 3% rent growth, because we tend to trend towards 3% rent growth over time. We can be above or below, but we trend towards 3. Today, we're trending year over year towards 5, but on a quarter over quarter basis, there are now many markets in the United States that are going negative, right? So what we've seen is CoStar is the best collector of this data, right? CoStar owns apartments.com, and they have great insight into what it costs to rent apartments all over the country. So they're saying that in the hottest markets, rents are actually starting to come down quarter over quarter. So you're actually seeing the peak rent in a particular property being earlier this year, not being today, right? In an upwardly trending market, you want to look at the rent roll in an apartment building, and you want to see in a normal good building, your best rent is the lease that you executed like a day ago, right? In a perfect world, right? And then if you look back over the last year, you will see that on average, your 1 year ago, that lease that's expiring tomorrow should be lower than the rent that you're just signed up for today. That's that 3% rent growth. You can see that in an apartment building, you do it year over year. What we're seeing right now is that if you are in the Orlando or in Miami, in some of those markets, the rent that somebody signed up to pay 2 months ago, 3 months ago, is higher than the lease that was executed yesterday. So we see that on a quarter, so that's quarter over quarter, right? 3 months ago, cheaper today than 3 months ago, but year over year is still up. If what we expect to see, and our anticipation of the market is Do we think that rent growth will go negative year over year? We don't. What we do expect is that we see a fast tracking to 3% year over year trended rent growth, right? A crash to normalization, right? That is what is happening right now. A massive off ramp down towards normalization.
Well, what's driving that? It's not interest rate. It must be macroeconomics. What do you think is driving that downward shift in rents?
Yeah, so I think, well, I think a number of things. I think some of it is bigger picture macro. I think there is less. Well, also think through that there's a little bit of you set the expectation. Sometimes the market meets your expectation. I think the expectations and the demand for that next bigger rent are starting to taper. Affordability is setting in, because at the end of the day,
it's like a bounce. It's like a bounce off the top almost. Yeah. You know, I was talking to somebody in Miami. You mentioned it. They were telling me 2% rent growth a month. Like, what? How is that possible? It's just unrealistic. It feels like a bounce off the top, but with maximum, we're still with full employment. Is this, you know, the canary in the recession coal mine?
The answer is maybe. It's like jury's out, hard to tell. But what I would say is that knowing that we are now starting to price, you know, the market is digesting this concept of, you know, mild recession is coming. It is now part of, like, you know, the base case for most people, right? In a mild recession base case, you should expect that rent growth probably will flatline for a period of time. And not only, and maybe on a nominal basis, rents still tick up. But what happens in an apartment market is that concessions show up, right?
Yes.
Hey, I will raise your rent 3%, but I'm going to give you 1 month free. Isn't 1 month free 8.25% of a year? Yes. So you're going to raise me 3, but discount me 8. It sounds like I'm discounting 5. Yes, you are paying less rent next year in a concession market. So I think in a mild recession, that is a reasonable expectation. Expect certain markets to start putting out 1 month of concession, which in their minds means I'm going to give you a temporary benefit such that I can keep a nominal rack rate in place, so that when the economy does turn around, I wipe away the concession and I grow the face rent and I snap back to bigger NOI. That is how the landlords play the mild market game, you know, recession game, right? The deep recession does turn into absolute downturns in rack rate year over year, right? And again, we're seeing that, like I said, in that quarter over quarter analysis, we've already noted that there has to be something to give. Now, the give has not yet turned really into concessions in a lot of these markets. And because the year over year is still good, you can still rent another unit below what you rented 3 months ago, because you're still substantively above last year. That is the litmus test for an apartment building. Are you growing rents year over year, right? So, and then you look at, and then the finer analysis is like quarter over quarter. So yes, I fully expect that, like, rent growth kind of crashes back to normal. Cap rates are going to have to continue to expand at some reasonable clip. They're sensitive to interest rates today because the cap rates are so low and the rates spike so fast that it is forceful enough to drive cap rates. If we start to see a market where rent growth is normal, it's moderated, but it's kind of normalizing. If we see some give back in the spike of interest rates and things start to normalize on the rate front, then you put those together and say, we should probably means that we get back to a market that feels much more normal, feels probably more 2017 to 2018-ish. And then you would probably actually, at that point, you might start to see cap rates compress a little bit again, as everything kind of filters back into, we're trading in the band again, right?
But you know what's cool about this downturn, actually, is that this one, in contrast to the global financial crisis, 2000, whenever, 2007 through 10 or whatever period you want to call it, is that then we were looking at the potential of a systemic failure of the financial system. Everybody felt this thing was out of control. This time, I love this expression, this time is different because this time you have a managed slowdown. This is direct, this is managed, right? Yes. This is somebody is, the Fed is determined to slow the economy down to reduce inflation. So it feels, even though it feels easier to predict where we're going to go than the global financial crisis, where you didn't know if we were just going to go straight off, into the abyss. It was like, I remember I was talking to somebody who said, it feels like we're standing on the edge of an abyss about to take a big step forwards. That's what he said one time. So it's different. Now, let me ask you this question though. So with you guys don't do ground up. Have you done much ground up?
We do 20, probably 20 to 25% of deals are ground up. Sure.
Ground up. Because those are the ones that I remember when I was first in multifamily real estate in the 80s. I remember, and it was all ground up, Class A ground up multifamily buildings. And I remember driving around town right after the savings and loan crisis. And by the way, this was during an era of 18% mortgages and 12%, you got on your deposits at the bank and everything. And I remember seeing banners, these concession banners going up on these new properties. So is that an asset class that is particularly susceptible, do you think, the ones that are coming out of the ground and going onto the market now for renters, ground up Class A particularly? What do you think?
So overall, I think the answer is, will there be particular distress, I think, in ground up? I think the answer is really no. And the reason I think that it's not necessarily the case is that because this is definitely also particular to the multifamily sector and say multifamily and industrial. There's still underlying fundamental demand, and the demand for industrial actually still remains very strong. Like in deals that we've done where we've gone into ground up industrial, as soon as you're putting the walls up, you're leasing, and projects are delivering into 40, 50, 60% pre-leased, and then leasing up the remainder right up to stabilization inside of a year. So the demand for industrial real estate to occupy it is still good, even what's going on in the markets. This is just like this is a pricing rediscovery exercise that's going on, rather than will people show up and lease industrial. Similarly, in multifamily, although I think multifamily is starting to show that we're catching up a little bit. And what I mean by catching up is that coming into this year, you had a market where we were probably roughly, different people debate the numbers, maybe on a multifamily scale, like 750,000 units, give or take, undersupplied for the US market. So across the US, we would probably say if we had 750,000 more units, we should probably be in a relative state of equilibrium. Therefore, new supply on top of that would be probably suspect supply. But we've got more demand than supply. And we had been delivering, call it 450,000 or so units, leading up into this year. Now, today, we're delivering something more along the lines of 600 to 650,000 units. That's probably going to decelerate some. So multifamily supply is actually starting to catch up and is starting to outpace the organic absorption. So in the short term, that's not a problem because we still have enough demand. And you can see that still in that, RealPage, for example, shows that occupancy rates nationwide went up to 97% earlier this year. And that was like the highest ever recorded, right? So, and we would, and normally in a multifamily market, we view 95% as like a very nice stable occupancy.
Right. Exactly.
In a market that has oversupply, that trends closer to 90. So nationwide, we have gone now from 97 back to 95. And so we're back at like a good trend line number, and we're still absorbing multifamily units. Now, from here, the interesting question becomes, okay, does household formation continue at the pace that it has? Because during recessions, they tend to slow, right? That's the I lived in a 1-bedroom, I'm going to go get into a 2-bedroom with a buddy and save some money.
Right.
Or I'm 3 years out of college, I'm going to go back and live with mom and dad again because that's a recession, right? Those things are real. Yes. So now I think in the mild recession scenario, you would say, okay, we're still probably going to create households. We're not going to destroy them, but we're not going to create them at the rate that we have been creating them. So we should expect a slowdown, deceleration in household formation creation. We have a supply of multifamily that has been coming at a faster clip than historically average, but we're catching up. So to me right now, and this is how we look at it, is that in a market where we're thinking about developing right now, what does that market really look like? Is it a market that has had a lot of supply come to it? And is it a market that if that job growth rate that had been driving all the reason behind building the new apartments, if that were to slow down, could this market overshoot short term? And if the answer is yes, then we're like pausing a little bit. But if we look at a market and say that market by and large hasn't had a spike in supply, and we can, there's good data on which markets have had the most units built in the last 12 months with the most units coming in the next 12 months. If a market looks fundamentally sound, and we said, look, we can even experience some deceleration in the rate of household formation and still have enough demand there to absorb what we're going to build that is going to deliver in 2024. And again, this is where it's like, there's a little bit of crystal ball here because we're making a decision today for like, what are we going to actually experience 2 years from now? Those are the scenarios where we think we could still potentially develop. And now tying back into what we talked about before, it is, what is the cost to build? And what is that untrended, unlevered yield on cost that we're going to build to? And how does that look like relative to where cap rates are going? Because it's one thing to build a market. So, using these rough numbers, I said in the past, there's a lot of multifamily that would have been built at a 5.5% untrended yield on cost, even 5.25%, even 5%, because they're like, no worries, because rents are going up fast. Right. And cap rates today are 4.25%. So my 5 untrended, by the time I deliver, it's going to be 6.5. It might even be 7 if I'm lucky. And I mean, the cap rates are 4. So now look at that. I'm solidly 6.5 selling into a 4 market. That's a 250 basis points compression that translates into the profit. And for those of us in the industry, we would say in a normal kind of steady market, you'd like to see 150 basis points of compression. Therefore, that's a really juicy build it and sell it and make a lot of money deal. Now, what I would say is that, okay, there was a lot of that happening. Things that were built 3 years ago, 4 years ago that were sold in the last year or two have historically, like almost categorically outperformed expectations. Okay, the game has now changed. Now, cap rates are going up, rent growth is coming down. There's the prospect now of a mild recession on the table. We know that's going to translate into, a decelerating rate of household formation. So everything's getting worse. So hence, if you're going to do that development today, you better have enough, what I would call wiggle room in that thing, right? Enough margin of error. So to say, even with understanding that we're not in a 4% cap rate sale market, we're going to sell at a 5 cap. And of course, we're not going to trend rents at 5, 6, 7%, like they had been, like that had been a layup 3 years ago to assume that. No, we're gonna not trend rents for 1 year, 0, and then we'll go back to 2 and 3, something like that, right? Moderate assumptions. And if we can do that, and we can still make an attractive rate of return, then I would say that you have a deal today that still makes sense to go build. We can still build some, because peeling back to that 750,000 units of undersupply, there's still reason to build units. It is just not nearly as compelling as it was a year ago. So right size it, acknowledge that you have some headwinds here, but acknowledge that there still is a national shortage of housing. Operate within that paradigm. You can make money. You can go do a deal.
So let's move to investor sentiment, but I'm going to share something. So when I worked for East West Bank during the last downturn, They wanted me to come in and help clear the balance sheet of non-performing loans. And I came across a guy who had a very interesting business model here, a major player. Like, you would never know this guy, totally under the radar. And what he does is he builds large condominium buildings,
Okay.
and then sells just enough essentially to pay either off or significantly down the debt that he had putting the thing together, holds on to the remainder so that he still controls the HOA, and then just rents those out. It's actually a brilliant model, brilliant model. And you would never know this guy because he's under the radar, but owns half of the condos in LA, as far as I can tell. But what I like about what you're talking about is this, the sense that I'm getting from you is that we're really just moving towards normality. You know, what we've seen over the last few years has been kind of an aberration because of excess liquidity and unnaturally low interest rates, and everything's kind of now stabilizing to normality. How do investors think about it? What have you seen in accredited investor behavior sentiment? How have you seen that change over the last, assuming that it has changed, over the last year or two?
Investor sentiment has definitely changed over the last year or two. And if you want a decent proxy for investor sentiment, you correlate it to the S&P. It is down relative to where it was. I mean, and it makes sense that it correlates to the S&P because those are portfolio, those are investable dollars, right? So knowing that pretty much every investor on the marketplace has equity market exposure, they probably have a decent amount of it. Mm-hmm. So when equity markets are booming, what we would see is they would be culling from pairing, taking down profits off of stock trades. Hey, I'm great. I've been long this equity portfolio. I'm gonna monetize assets here. I'm gonna create liquidity, and then I want to diversify and invest in commercial real estate because again, the transition is I'm gonna take a non-cash flowing, appreciating asset, and I want to turn that into hopefully a cash flowing and appreciating asset. But I'm going to play the long game because now in real estate, we have the benefits of depreciation and we're now getting into better tax treatment and so forth, right? Real estate, by and large, is generally more tax advantage as an investment than equity markets. So, but that phenomenon was spinning and that was benefiting. So the rise in the S&P over the last, since CrowdStreet has existed, has benefited our marketplace. Absolutely. Right now, you turn the market upside down. Of course, that's going to make investor sentiment. They're cautious. But what's interesting is I would say that we're still seeing these pockets of conviction. And so if a particular investment or deal, if it's compelling and if it makes sense today, and knowing to say, hey, look, we've assessed this asset and we believe that in today's market, it's a compelling value because of this. And if those things make sense, and understanding that the commercial real estate market is an inefficient market, right? An asset in every stage of a cycle can be overpriced, fairly priced, or underpriced, right? And you have to make that assessment to say, am I buying? And what you now kind of know sometimes in rearview mirror is that there were definitely a lot of assets. I mean, we felt it last year, but we would shy away from it. But it was hard to argue the last year if somebody was, in our minds, overpaying. You had no basis to say you're definitively overpaying. All we could say is that trade looks very rich because it just set a record, and to underwrite that asset to a reasonable rate of return. So on an acquisition, call that low to mid-teens IRR on a 5-year hold, you have to assume some
big assumptions. Exactly right.
Like you're making a series of optimistic assumptions to get to a return that is no better than the return in the past. But the assumptions got more optimistic. To me, that's the telltale sign of probably overpaying. Time will tell. And now you would say, yes, you were overpaying then. So today, to get the conviction that you're not overpaying, now that pendulum is swung. Now you have to say, despite the fact that all this bad stuff is hanging out here for the next year or two, to do a deal today, you're still making the fundamental underlying assumption and kind of quote unquote bet that 25 is better than 23. And if 25 is not better than 23 in your mind, then then go to cash, like, right? Because that's probably just, even in an inflationary environment, what you're basically saying is lock up a small loss to then get to asset pricing that will then go down, because the S&P will drop. If 25 really does start to look as bad as 23, well, then guess what? The S&P is tanking again. All assets, everything is tanking again. There will be a deeper trough than what is probably currently assumed, to say that, look, you would hope and think that trough is coming by the end of next year.
So, are investors looking for, I'm going to talk about accredited investors, and we should start wrapping up. You and I know we could talk hours and hours, but let's not go too long. Are investors looking for distressed deals? Are they animated by the idea of bargains?
The answer is yes. And so now, distressed deal is an interesting term, because I don't think
it is,
deals, I don't like, in the true, if we say GFC distress, there's very few deals. I mean, you have to go to the worst office assets today, those are approaching GFC distress. Otherwise, assets are really not distressed. And again, remember, we're crashing back down, but coming off of a catastrophic upside year. So we're giving back all the gains, right? So then the question is an asset really distressed? Is if the price you're buying it at today is back to like 2020 pricing, which by the way was more than 2019 and 2018. The answer, and it's still occupied and it has some rent growth in it. So the answer is really no. But is it a relative? Are you getting to basically value relative today? So where you want that pendulum to swing, and where the investors will lean in, is even in today's market, we think fair value is X, but we've leveraged a maturity, a motivated seller, something in the deal, a coming up expiration of a tenant, something in that deal to say, if the deal is worth X today, which means it's already discounted 15% from last year. But if it's worth X today, we're actually buying it at 0.95X. And here's why. And that is what's going to give us what we believe is the alpha in the deal over the coming 5 years to get to a good return. And the answer is, at the end of the day, we don't really know. But what we think we know is we probably could actually sell that asset for more than we're going to go buy it for today in a normal sales process. It's kind of like that's part of like why you do deals today. So there has to be what we would say blood in the water.
Yeah.
But the blood in the water is going to be probably more if it's an element of distress around how the financing of that deal has changed.
Well, that's the point, isn't it? Yes, my view, there's no such, I've traded billions of dollars of what are called distressed real estate, but I don't think there's such a thing as distressed real estate. The real estate is fine. It's the capital stack that's distressed. And we were actually running a campaign for somebody who was on the a Facebook ad campaign, marketing campaign. Somebody was actually listed on the CrowdStreet platform. I won't say who, it'd be totally indiscreet. But they were able to negotiate a huge discount in their purchase price. And what we noticed was that cost of acquisition of a new investor lead went up dramatically when we started using language that wasn't earn income and build wealth, and switched instead to essentially take advantage of this amazing bargain. Then we suddenly found acquisition cost of investors dropping precipitously, because it seems it seems a bit crass, and I don't want anyone to take offense, but I think it's human psychology, is that you kind of feel like you are benefiting at the benefit of, or you're taking advantage of somebody else's disadvantage. And that's motivating in some way.
Right. Or to put it differently, is that sometimes there's a perception that it is a zero-sum game. And so therefore, right, if there is going to be a winner, there has to be a loser. And typically you don't want to be the loser, right. So you would prefer to be the winner. Right?
A period of wealth transfer. That's exactly. All right. So Ian, let's wrap up with 3 rapid fire questions.
Okay.
I ask all of my guests. So the first rapid fire question is, what are your daily habits, your personal daily habits that keep you productive and successful?
One, reading, so immersing myself in current events, data, and relative to the market, combined with, then the other thing is taking daily notes about what I'm supposed to be doing, when I'm supposed to be doing it, and checking those notes and then checking it off, right? You have to kind of check yourself, right, as you go. Otherwise, too many balls can get dropped because there's lots of things going on.
Yeah, awesome. My last question is, hardest lesson learned. What's your hardest lesson learned in real estate?
Oh, hardest lesson learned in real estate was 2000. Like it did happen around 2009. Don't kid yourself into thinking that the supply in a market can vastly change. If you think you have a nice little hidden secret, it takes one change of one market participant's mind to flood you with supply and blow your investment thesis out of the water.
That's really interesting. That's really, really cool one. Be
careful on the this is a hidden secret, because sometimes those are too good to be true, right?
Yeah, somebody else also know it and they have their own secret. All right, last question. So for investors, accredited investors looking to invest today in commercial real estate, what advice do you have to them, for them?
My advice is look at the market in a sane format, right, with realistic expectations. And what I mean by that is expectations of what we have experienced leading up into the pandemic and through the beginning of the pandemic, probably unrealistic long-term expectations. How we look at the market today, and why I'm still and I'm biased, but I'm a believer in the returns that can be generated in commercial real estate over the ensuing years. I would say there's a little bit of relativity in there, because I love the prospect of CRE returns that will beat the S&P by a margin. Now that margin might be, but that absolute return could be lower, but the margin will hold up. So don't chase the 20 IRRs, basically. If I thought a deal was honestly thought it was an 18 IRR 4 years ago, underwriting it, I'm underwriting it with the expectation that it will be a 14 today. That is a way and I will take that 14 because I think that I will be happy with my relative rate of return for my other alternatives of investing.
You are going to make a lot of very conservative, prudent, seasoned sponsors very, very happy with that. I'll tell you right now, Ian Formigle, Chief Investment Officer at CrowdStreet. What an enormous pleasure. Thanks for joining me today.
Thanks, Adam. Absolute pleasure.
That was Ian Formigle, Chief Investment Officer at CrowdStreet. And to find more about Ian and CrowdStreet, go to the podcast page at gowercrowd.com. Sign up for our weekly newsletter. It's completely free. And be sure to pick up your copy of Unleashed to learn more about how online syndication, aka crowdfunding, has come to dominate capital formation in the commercial real estate industry. All there at gowercrowd.com. Hey, Ian, thank you so much for joining me. It's a real pleasure to see you and to hear your insights into the market and to get a better sense of where we are likely headed. And thank you, of course, for tuning in. I hope you found today's episode as valuable and interesting as I did. It's always a pleasure to have these guests on the show, and I really enjoy recording the episodes and hope you enjoy listening to them. That's it for today. Be well, stay safe, and for now, this is Adam Gower signing off.